Michael with you today, and I trade binary options on PocketOption platform. And in the description below this video, you'll find a link to my private Telegram channel where you can find a lot of useful information about trading signals and etc. So I want to inform you that if you go there, also you will find a link to register on PocketOption platform and get your 50% free on your deposit. So today I start with a deposit of $9,000. As we can see, the price is going up a lot. I don't see any other entry point other than up, so I'll go into 200 purchase. Let's discuss today when is this worth fixing losses. Selling unprofitable positions is a very difficult decision for any investor, and obviously no one will want to intentionally buy shares that, in their opinion, will fall in price and will be worth less than they paid for them. But in a diversified investment portfolio, losses on some positions are an integral part, especially in difficult economic times. And the task of any investor is not to completely get rid of losses, but to try to minimize them. First of all, this is carried out due to the initial point selection of high quality assets. Secondly, by diversifying the portfolio and including protective assets in it. It is also worth remembering that the loss on the stock until it is sold is virtual. But sometimes even the most successful investors face the need to sell shares at a loss. This decision is actually very hard to come by. It is not emotional, but the conscious fixation of a loss on the stock that often separates successful investors from the rest. But not every unprofitable stock is worth selling. We need to take a balanced approach to this issue. The deal brought us $384. The price continues to rise and I see no reason for a reversal. I go for it. I go into the purchase for $200. Despite the fact that most major stock indexes show a long-term growth trend, you can find a lot of volatile stocks with reverse dynamics. This is the key risk in investing that every investor assumes. That is, the shares of individual companies may stagnate even with a growing market, and they may also show a decline in the long-term horizon until the liquidation of the company, and vice versa. There are always stocks that are much ahead of the indices of which the vast majority of the investment portfolio should consist. But even the shares of successful and promising company may fall in short term due to the general negative background. Take the same Apple. It could make losses in 2000, 2008, 2012, and etc. But in general, it is a growing company, and imagine the disappointment of investors who sold it at a loss at such moments. If there are often unprofitable stocks in the market, then why do the indices show growth? It should be understood here that the indexes mostly consist of successful companies, but less successful stocks could also once have been part of the index, but due to a significant drop in their value, stronger companies took their place. Indexes are always replenished by excluding losses and replacing them with winners. So the deal brought us $384. While we were talking, the price went down a lot after closing the deal, but for that I opened a new entry point, and yes, I'm buying again. I go for $200. When to sell shares. In general, from the text above, it is already possible to understand when to sell unprofitable positions. It depends on your trading strategy, as well as on their share in the overall structure of the investment portfolio. You can hold stocks at a loss for a longer period if they make up a small part of your portfolio and do not significantly affect the value of your portfolio. But here the investor should be aware that the funds frozen in such shares could work and make a profit if they were transferred to another asset with more obvious potential. The investor can also continue to hold shares if good dividends are paid on the shares. This is a compromise solution. There is a loss, but it is compensated by the dividend flow, due to which in fact the losses may even cut to nil. However, if the stock goes beyond the technical level or the company is not performing as well as at the time of purchase, it is better to sell it at a small loss than to allow the position to freeze their money and potentially bring even even greater financial losses. The deal brought us $384. The price continues to rise and I follow it. I go into the purchase for $200 mergers and acquisitions. Another potentially compelling reason to sell in the announcement that the issuer of the stock has very real reasons to be absorbed. After the acquisition is announced, the share price of the acquired company usually rises to a level close to the agreed purchase price. Since further growth potential may be very limited, it may be advisable to fix the achievement result, loss or profit, shortly after the announcement of the acquisition. Here, the decision may be influenced by the method of acquisition and cash, shares, or a combination of them. In the case of a cash purchase, the stock price usually approaches the purchase price quickly, but if the transaction is not completed, the company's share price may fall again, so it is worth keeping your shares for a long time after the announcement of the acquisition for the cash. In the case of transactions involving the conversion of shares of an existing company into share of an observing company, your decision to hold or sell should be based on whether you have a desire to become a shareholder of the acquiring company. The deal brought us $384. While we were talking, the price went up sharply and rolled back after closing the deal, but since there is such an entry point, then I will go into the purchase for $200 when not to sell shares. This is an equally important question, and an ill-considered sale of shares can lead to lost profits or losses. It is important to know clearly when not to sell shares. Here is a list of some situations in which it is not recommended to do this. First, do not sell shares just because their price has fallen. Every investor wants to buy cheap and sell expensive. Selling shares just because their prices fall literally does the exact opposite. Bought for expensive, sold for cheap when falling. Do not sell shares because of the draft, hype, panic, and etc. Decisions made in a hurry under the influence of external factors, often not affecting the company, usually turn out to be erroneous. It is always worth approaching the sale or purchase carefully and without haste. There are situations when an asset has fallen very much, 80 to 90%, and its sale doesn't make much sense. The investor has already lost more than 80% of the invested funds. The deal brought us $384 as usual. For today, I'm finishing with a deposit of $9,920. I thank you guys for watching this video till the end. Don't forget to like, subscribe, and comment this video and share with a friend is he interested in this topic. So also I recommend to go by the link in the description to my private Telegram channel where you can find a lot of useful information and daily trading signals. I wish you only successful trading session, guys, and goodbye. Michael was with you. Bye.